All right. So tonight we have a great honor. Kirby Wiesen, he was head of the catastrophe modeling. Make sure your volume's off over there, Victor. All right. He was head of the cat modeling and reinsurance at USAA for many years. He and I worked together, and Melissa, and forget the whole department. And Kirby, I interacted with Alice Gannon on Facebook not too long ago. She's amazingly still remembers all those years of us all working together. Is a fun team, but obviously a time where, you're talking catastrophes, so it's a tough risk to manage. And Kirby was best in the business, I think, just his knowledge. So he's obviously is going to be simplified for us because this is very advanced actuarial science. Kirby, we have a few actuary majors in here. We also have one team that's doing a paper on catastrophe bonds, as I mentioned. So we might want to talk a little bit about that. We talked some about catastrophes. They know what a PML is. I can't remember what an MPL is, but we know what a PML is. They have one math question they had to do on that on the exam. There's things I can't remember what they mean, like reinstatement. So when you get to the reinsurance, you might define some of those terms. So it'd be good to have some terms, new terms I can think about. And I told the team doing the cat bonds, to the extent you talk about reinsurance and catastrophe bonds, they can make that part of their paper as part of their research. And so take good notes tonight. Also, we have a team doing climate change. So you might give your opinion on climate change and impact on hurricanes and other things as well. So there's some topics that they could actually make part of their paper. I can't give an introduction as far as your background. I know you're an actuary and have had a career before USAA, but a long career at USA. So I'll let you, if you like to introduce yourself, but I'll turn it over to you, Kirby, and we might ask questions as we go. And so I'll let you know, I'll interrupt if someone has their hand up. Thanks, Kirby.
Okay, great. My name's Kirby Wiesen, and I was as an actuary at USAA for 32 years, and I was in the cat risk management department for over 21 years. So I led that area for those 21 years, the reinsurance portion, all those years, and then the cat modeling portion wasn't really off the ground yet when I started, but it was there. It just wasn't being run in-house. But so I have extensive knowledge on cat risk management. I have been retired for the last 2.5 years. So if you ask me what's happening in the market right now, you probably need to go ask somebody else, because I've not been keeping up with it in my retirement, probably as well as I could be. So anyways, cat risk management I'm speaking to tonight is really from an insurer's perspective. And it's an insurer's perspective from a personal lines business. But it's pretty much the same when you get to commercial lines or you get to a reinsurance company as well. It's just it's something that you have to do to manage risk. Any questions on my background or any questions about me?
Were you actuarial science undergraduate, or did you?
I actually, oddly enough, my degree is in dairy science, which is not anything close to actuarial science.
Okay.
And I went back to the family farm for a few years and decided that there had to be something a little bit more exciting to do. And so I went back into mathematics, and I was a graduate student at Southwest Texas State University, which I think now is called Texas State University. And I taught some remedial math courses there to try to get the students up to speed on where they should be out of high school and get them through college. Then I applied for a job at USAA, and then I took that job in 1990. And so I was there for 32 years. So I do have, I don't necessarily have a actuarial science degree. It's not necessary. All you have to do is go out and pass those tests, and that's really important part of your career, is to pass those tests and understand what's going on with it, and then to take what you learn and to apply it. I think will just further you in your career a whole lot.
Thanks.
Any other
All right, we're
questions?
ready. No, we're ready.
Okay. All right. Cool.
Wait, question. Sorry, Kirby, we had one more question.
Okay.
Mentioned that you were degree in dairy science.
I'm sorry, I couldn't hear that question.
He said he was confirming that you have a degree in dairy science.
I do have a degree in dairy science. It is important that you have a degree of some kind, but there's like chemical engineers. In dairy science, there was a lot of statistics involved, believe it or not. But there's I worked with chemical engineers, persons who were chemical engineers. I worked with persons who were accountants. I worked with persons whose past careers were in communications, teachers, English teachers. It runs the gamut. So, but I think a degree is important. You do have to have a degree.
So he has a follow-up question.
Was expertise in dairy science, has it ever helped you in your actual career unexpectedly?
Did that dairy science help you in actuarial science at all unexpectedly?
Yeah, I think so. I think it did help me because there's a lot of scientific analysis that goes on there, and we had a lot of experiments that we ran. And so I can apply that knowledge and those processes onto catastrophe risk management and just growing your knowledge constantly.
All right. All right, we're ready.
All right, very good. So most of this though was developed as we went through. As I went through my career, there in 1989 there was a large event. I believe it was Hurricane Hugo at the time hit, and it was a kind of a wake-up call for the insurance industry. They weren't real sure, if that was the biggest event that could possibly happen at that point in time. And then Hurricane Andrew happened a few years later and was even more of a wake-up call. That one hitting Florida, and so there was necessary something that you could do to analyze your risk. And so what I'm talking about here is not man-made risk necessarily, except for maybe you could consider wildfires partially man-made, because those can be set by obviously human beings. But the other ones, hurricanes, tornadoes, floods, and earthquakes, they're natural events, and so they are modelable. Now, whether you get them right or not, that's the $1 million question right there, right? So there's a lot of research goes on. There's a lot of people that work on these catastrophe models to make them so that you can actually analyze the risk. So the first thing in any risk management program is to identify what is your risk. And so from catastrophes, we use catastrophe models to do that. These are the perils. These are some of the primary perils. But there are other perils out there. There's even models, believe it or not, that will model meteorites, not necessarily for insurance companies, but there have been meteorites in the past that have caused quite a bit of damage in Russia, for example, and other places in the world. So, but there are other natural catastrophes, but these are some of the major ones here that will cause you a lot of damage. So as I was saying, go ahead.
Kirby, I saw an article. I'm going to talk about risk class about this. That sometime in the 19th century, I think there was some major solar flare that they think if it happened today would probably wipe out electricity and just. I don't know if you've ever heard of that risk.
Yeah, that is something that was being studied when I left the industry 2.5 years ago or so. But it is one of the things that we actually included in on as a risk on our reinsurance program is, well, what happens if there is a solar flare and the grid goes out? Well, that doesn't necessarily cause personal lines damage, like I'm talking about to homeowners or to necessarily maybe an auto, or maybe it does to some autos, don't know about that exactly. But it can cause a lot of food spoilage because your electrical grids can go down and such. And so that's the methodology. So we use back of the envelope technology to just try to figure out, well, how many policies do we have, and if we give $500 food spoilage for or some other amount for some for food spoiling in your refrigerator when the electricity goes out, then how much loss could we potentially see from that? So, anyways, they're a very simple model, but you can add a factor in to your model losses for that type of thing. So yeah, that is a risk. There's a risk there.
Now, I know you're gonna talk about frequency and severity, but on something like that, is there even a frequency number, or are you just making stuff up?
Yeah, that one you can, it's more of a, this is what your loss could potentially be. And so that's where hopefully you have the reinsurance in place to help you protect some of those losses. So frequency on that one is pretty hard to figure out. And that's a good point. So we can talk about frequency and severity. The frequency of these events that we're talking about, catastrophes, for example, earthquakes, they don't happen all that often. And so your tornadoes and such, they happen more often, but the frequency of those types of events are still relatively small compared to, something like an auto insurer that is protecting against, accidents that happen basically all the time. And there's thousands and thousands of records there that they can base their results off of. Well, catastrophes, you just don't have that information. And that's part of the reason that you have the catastrophe models. So you're trying to understand your risk. And I mentioned here trending those historical results, try to figure out, well, let's look at past hurricanes and past tornadoes and such, and let's trend those past events with the losses that we had in the industry from those past events and see, what the losses would be out into the future. We can figure out what policy growth is. We can figure out what the inflation factors are and that type of thing. And those are good results that you can look at. And they're good, I think, from my perspective, to use those results to calibrating your models and such on an individual event basis. But you have to be careful with that, because if you go back even 40 or 50 years, there's whole developments of whole towns that are now there that basically were either swamp or forest before. And if there would be zero losses in some of those locations from some of those catastrophe events. And if you trend zero forward, it's still zero. So you have to be careful with that. That's where your catastrophe models come in, and they're so useful, because what they're doing is they're generating thousands and thousands of years of events. It depends how much convergence you want using your models. So your reinsurers might use a simplistic, 1,000 years or something like that to come up with, but very commonly you use like 50,000 years, and then there's some applications that you might want to use 1,000,000 years. So, but anyways, I would say 10,000 years or 50,000 years of events. And so when you're looking at events, you have to multiply that. So hurricanes, if you had an average of 12 a year, then you have a lot of events that could be in your event set, just in the hurricane event set. And then when you get to tornadoes and windstorms and straight line winds and things like that, it becomes many, many, many more events that you have modeled out there. But these models are very, very sophisticated, and there's literally hundreds of people that are working on. There's all kinds of research going on to develop different components of these models. And so you can take these catastrophe models and you can run them over the exposures for an insurance company. And good data is the key here. So you want to capture as much good information about your policies as you can, where they're located, the exact location, how much insurance that they have on each policy, the deductibles, and what kind of materials the house is built out of, what quality of construction, what are the building codes in that area, and so on and so forth. And so that information gets fed into a catastrophe model, and then you can run that and come up with loss distributions from those catastrophe models that are very, very useful. You can use that to price insurance that you're selling. You can use it to determine what your risk is and your risk curves and what your probable maximum loss is and if you want it to, although we never really, they're your maximal possible loss. I'm not sure if that's really even possible to come up with that, but it was a term that I just heard a couple minutes ago. But anyways, you can look at those distributions and come up with use those distributions for all kinds of things. And one of those things is to manage your risk, determine how much capital you need to hold as an insurance company so that you're there for however long you want to be there. So if you want, less than a 0.2% chance or a 0.1% chance of failure from a catastrophe event, then you can set your parameters up so that you hold capital and you have protection from reinsurers and other types of sources of capital so that your company can withstand that and last for a long time. So any questions on catastrophe models? Because that's a very important part of catastrophe risk management as I'm talking about it tonight.
Kirby, I don't know, and this is for the team writing the paper on climate change. You mentioned Hugo, Andrew. Do you recall when maybe the first event, the first year, the term climate change started to come into CAT modeling?
Yeah, I'm not sure when the CAT modeling firms, some models kind of resisted wanting to put it in there at any point in time. But, the last 4 or 5 years of my career, it was certainly. So I would say, we started hearing about it in probably the 2010, probably somewhere in there. I would say it became more prominent, but the models really didn't come out with anything until even as late as some of them as late as 2000, the late 2010 years, like 2015 to 20 or somewhere in there, where they even came up with any kind of estimates. And there just wasn't a whole lot of good data on, well, what is this going to do to losses? And there's still controversy on that. Are we going right now? Is it caused by a sustained climate change long term? Which is probably yes, because there is evidence that even though they don't always agree on why the climate is increasing in temperature, that it is increasing in temperature given the information that I've seen. So, but then there's also cycles that happen, and then there's evidence that we've had ice ages in the past, and we've been warming for quite some time. So the climate is always changing, and I think it has to be considered as an important factor. But I think now you will hear a lot more about it from catastrophe modeling firms than you ever did before.
Right. Thanks. Anybody else? All right, good. I ask a lot of questions, but they'll jump in here soon.
Yeah, no problem. So anyways, that's your risk, right? You got to identify what your risk is, and now you have all this lovely information, and you always have to look at it very cautiously, by the way. But you can use that information cautiously to manage your risk. And so, what do we do to do that? And so, there's a couple things you can mitigate your risk and just get rid of it. Okay, so one way from an insurer's standpoint to mitigate your risk is to just get rid of it and let the policyholder just restrict policies from ever entering into a contract with you, right? So you just don't write it. You just don't write new business in those areas where you don't want to write it. But then somebody has to have the risk, right? Either the policyholder has to keep it, or another company has to take it, right? So that risk still exists. A much better way to mitigate risk is to build stronger structures and better structures. And so there's a lot of information out there that's been developed on, and your models also help capture some of this information to identify where you can reduce losses by building better structures. Florida has one of the better building code structures in place. Texas, I would say, since, we live in Texas, I'd like to say it was really, really good, but I would be very cautious if you were building a house along the coast in Texas. Don't trust on those building codes just too much. You might want to beef it up a little bit more than what they're saying. And you say, well, you're going to be in the way of a hurricane. So what's the chances of a building still being there? But, one of the places that we went to buy insurance, oddly enough, was Bermuda, this island way out in the middle of the Atlantic. And they had building codes there, and they were required to build their homes I think it's something like the 140-mile-an-hour winds or something. And they had the concrete roofs, and they very strong structures and reinforced glass all around. And I've been there just a couple of weeks after a cat, I think it was like a Cat 4 hurricane went through the island. I thought it was going to be completely decimated. And driving from the airport, you drive across the island, and any tree or anything that's tall will be blown down. But you get to town and you look at it, and there might be a window broke here or there and a little bit of damage and clutter around. But really, the structures are still there. They're not blown away. And so, they did it. And so we can do it too. And I think that there are a lot of areas that are starting to beef up their building codes. But not only building codes, but there can be voluntary discounts given by insurance companies and such as well to incentivize people to build stronger homes, and you can build them. Now, if you're in a flood zone, I'm going to say all bets are off, because once you get the storm surge, which is another risk altogether, natural risk, but that's where the waves come in and will wash your homes away. I'm not sure that you can build a home just strong enough to withstand some of that. You're best off maybe not building in those flood prone areas. But anyways, what I'm saying is you can build better structures, and everybody. What's that?
No, that you're good.
So policyholders are better. The insurance companies are better off, and so I'm a strong advocate of that, and I think companies should be as well, and individuals should be. And lastly, what you can do is you can transfer risk, and part of it goes back to kind of the first bullet on mitigating risk. You can have restrictions in place, but you can give that risk back to the policyholder, right? There are companies that go out there, and even though they wrote you in the past, they will say, sorry, you're in a cat prone area, we're not going to write you anymore. Now you're scrambling for insurance. There are other insurance companies that I'd like to think that are a little bit more, is that once they have you on your books, they're going to keep you there. But maybe they won't just write new policies. But you can give that risk back in several ways. You can not write their policy, leave them uninsured, and you can restrict coverage. And that comes in various forms. So it can come in higher deductibles, let the policyholder, pay more of the loss at the bottom where, they could have losses, or there can be co-insurance limits, maybe not on personal lines, but you see that quite a bit on commercial lines. And then you can have limits on coverage, and some of your wind pools. I'm not sure if you're familiar with wind pools, but basically they're kind of a government managed insurer along the coast to help protect some of the homes there, where insurers won't provide coverage for the prices that the government will allow. And there's limits on coverage placed, especially in some of those wind pools. I think even the Texas Wind Pool Association might have a limit of maybe $250,000 on a house, if I'm not mistaken, but they might have increased it over the last couple of years. I just don't know. And then lastly, what you can do is you can transfer some of that risk to other organizations. So other reinsurers that want to help participate in providing, for profit. Obviously, that's what they're there for. And or there could be investors out there that think that they can manage this risk better than the primary company, and will basically sell some reinsurance so that the primary company can continue to do business. Any questions on any of this? There's a lot to capture right here, but that's this slide right here is basically you go back to the basics all the time for any kind of risk management that you're doing.
We're good. Sounds good. Good explanation.
Okay. So there's a couple different types. I'm going to concentrate on reinsurance because I think that's where the focus wants to be instead of not necessarily cat models, but getting into reinsurance and transferring risk to a reinsurer. There's a couple different basic types of reinsurers that you can use. You can use quota share coverage and you can use excess of loss. And quota share coverage is pretty common, especially if you're a small insurer. And let's say you're starting out, or maybe you're a Texas Mutual of some kind, don't have a lot of business everywhere. And so what you might do, not only for protection from catastrophes, but just from all losses, you might buy a quota share coverage and say, well, I tell you what, we're good at writing policies and dealing with the persons out there and settling claims and such. But if you would help me write some of that, I'll give you a percentage of my premium if you pay me the same percentage of my losses. And so that's pretty common out there in the industry to have this type of coverage. The way it is, let's say it's a 25% or maybe even a 50-50 quota share. Let's say 50-50, I give you 50% of the premium. You give me back 50% of the losses. And it took me some expense in order to put that policy on my books. And so, Mr. Reinsurer, you need to pay me a little bit for all the costs I had for the computer systems and going out and visiting with the insureds and all that. You need to pay me a little bit for all of that as well. And so there's a ceding commission that you can set the price on. And that the reinsurer will give back to the primary company kind of to set the price on the contract. The one thing that's bad about quota share reinsurance is usually the reinsurer doesn't want to be out of a lot of cat losses either, or a lot of losses that are unforeseen. And so they'll place caps on coverage. And usually when you get to a quota share, they like to start the conversation as, oh no, we won't have any caps on our quota share coverage. And then when you get down into the weeds a little bit more, then they'll start saying, well, would y'all be interested in a cap? Once you've spent like several months of time analyzing the type of quota share that they offer. And so there's usually always a cap on coverage. Don't let them fool you on that. And so usually it comes in amount of premium, and so they'll cap it at per event or something like that, that it will cover no more losses than like 3 times what your premium is or something like that. So there's usually caps on coverage. The more common type of coverage is excess of loss coverage. And that's where you have a lot of your insurers and even reinsurers buying coverage to help cover those big losses, the hurricanes, the tornadoes, the earthquakes, and I would say that it's definitely the primary one that's out there in the industry today. There's 2 types, I would like to say, and there's everything in between and probably outside of any realm. So whatever kind of legal contract that you can come up with that's within regulations, and there's not a whole lot of regulations on this stuff. You can come up with it. So we'll cover both of these. We'll cover just a little bit about this and what maybe you need to think about when you're buying these types of reinsurance. And again, this is very basic, and we can go in more into the details if you want to ask more questions. But there's traditional reinsurance. This is like your Lloyd's of London, your Swiss reinsurance company, your Hanover reinsurance company. There's literally hundreds of reinsurance companies out there that will provide risk coverage on an excess of loss basis. The other one is insurance-linked security reinsurance. And it goes by many other names. You can call it catastrophe bond reinsurance, and there's other names out there for it as well. But there's more protection here usually than what you can get from a traditional reinsurance. Not the amount. I'm not talking about the amount of coverage you can buy, but just the fact that if you have a traditional reinsurance company, they can go bust just like any other insurance company can go bust if they don't manage their risk correctly. But for an insurance-linked securities, we'll see here in just a couple minutes that there's a a trust fund basically that backs up your coverage so that the insurer can be a little bit more secure in the type of coverage that they're buying and that they'll actually get paid after the event. But you usually do pay a little bit of a premium for that safety. So any questions here before I go on? Just explain what an excessive loss reinsurance coverage is. So this is very simple example, catastrophe excess loss insurance. If you didn't have any coverage at all, I could have shown this in a separate slide, but I think you can figure it out. The red bar there, if you had a $5 billion of losses and you had no reinsurance coverage at all, basically, how much would you have to pay? Well, you'd have to pay $5 billion. Okay, so that's pretty simple. But now let's say I want to buy a reinsurance policy. This is a quite large reinsurance policy. Actually, the layers probably wouldn't never be quite so big, or maybe they would, depending on how much coverage you need. But in this simple example, the coverage starts at $1 billion. So if the insurance company aggregates up for a single type, maybe loss or event, or maybe it's a year of losses, it's how you define it in the contract. But whatever how you define it, once it gets to that attachment point, your coverage kicks in. And then they pay, in my example here, I say 90%. So the reinsurer will say, I'll pay 90% of your losses above that, but I'm going to put a cap on it at the exhaustion point of $4 billion. So as you go through that layer, the reinsurer will start paying more and more of the losses in that layer until you blow out the top of that layer. And in our example, we had a $5 billion loss. So it's pretty simple. You just take the exhaustion point and you subtract the attachment point, and 90% of that, and you can see here that in our example, we had $2.7 billion of coverage. Well, that's a nice little chunk of capital that you didn't have to hold because you have this reinsurance policy here. So that's the reason that we're buying reinsurance, and that's the reason excessive loss is so valuable. Any questions right here?
Kirby, this may be just for me, but I like the actuaries who have some jargon. So I never understood exactly what reinstatement means. When they talk about we got one reinstatement, two reinstatements, can you define that in a way that?
Yeah, so reinstatement is not really all that complicated. It just means, see that layer right there? I have $4 billion, basically from $1 billion to $4 billion. Basically, I get two of those. And so if I have two events in a year, it will pay up to, in this example, 5.4 if I had a reinstatement. Now, let's say that I paid I don't know, for this coverage here, let's say I paid, $50 million. I don't know what layer, what attachment, and what risk it is, but say I paid $50 million. So once I blew through this layer as an insurance company, I'd pay another $50 million. And it's usually written into the contract that, no, I don't get the option of paying $50 million. I have to pay $50 million if I have that reinstatement written in there. And so, but now I have another full limit of coverage that I have in case another event or another aggregate year comes along and blows through this thing again. So
the reinstatement is only if you eat through the 4 billion, your loss, or if it's
actually it's usually written, that can be worded like that, but it's how the contract is written. So, but usually the way it works is that it's any piece of it. So let's say I only use half of it. And so instead of going to $4 billion, it's a $3 billion layer. So let's say I went to, $2.5 billion, and I used only half of it. Then I would reinstate only half the limit at that time. And I'd pay $5 million to reinstate half the limit if an event exhausted half of it. And so if I had another event that went through half of it again, then I could still reinstate it a full. So when you have a reinstatement, it usually means that you have two full limits but you only pay for the portion of it to get reinstated to the full limit again that you actually used up.
All right. Ah, that makes sense. Wow. Okay. Wow, complicated contract. Okay.
Yeah, it actually is written in there. And you know, actually, when you look at the reinsurance contract, it's pretty simplistic, and everybody just kind of knows what it is. When you're saying it's, you know, pro rata reinstatement, and then everybody says, yeah, okay, we've got it. And so, but if you want to change it from what everybody is used to, that's where it gets really, really complicated.
Yeah,
And
I was just curious because let's say, and you explained this, but let's say you just barely ate into the green. And I was worried that you barely eat into green, you only get 5 million in coverage, and now you got to spend 50 million on reinstatement. But you're saying the reinstatement premium reflects how much of the green you eat into.
yeah, if you use up only 10% of the layer, you only have to pay 10% of the premium.
Okay.
So, so you know, if you have an attachment point, and this is probably getting a little bit more complex than we need to get here, but if you have a really low attachment point and you have a reinstatement, you have a really tall layer. So the tall layer is going to get you a reduced price because at the top part of the layer, the risk is not near as much, right? But if you have these reinstatements where you can keep hitting that low attachment point many, many times, then reinsurers have to make sure that they are calculating the risk right for that layer because it can be huge. So
yeah. All right. Thanks. That helps a lot. Any other questions?
And normally you have software and stuff that will help you out, but you have to make sure that software works. But I mean, at the very beginning, these catastrophe models didn't have the software to help you figure this out. But you know, you have 50,000 years of events, and you can go through this many, many times. That your software will actually calculate, you know, how many times that layer on average will be pierced and so on and so forth, so that you can figure out what your loss costs are. And you can load in your expenses and stuff like that and calculate what your premium should be. So they're very, very helpful. But again, we can't always trust what's been programmed. So you have to make sure it works somewhere.
Thanks.
So first, I'm going to apply this now and switch and say, okay, well, this cat reinsurance, you can use it. You can use it for a traditional type of reinsurer, or what I've mentioned before, the ILS or cat bond reinsurance. Either one, it works, and it's used in both. I will say that your traditional reinsurers will more often. Ron brought up a reinstatement. More often, your traditional reinsurers will provide that reinstatement. It's very complicated to include it in an insurance-linked securities transaction, and we'll go over that in a minute. There has to be money backing everything up, and when you have a reinstatement, it makes it much, much more expensive to back up that second reinstatement. That first reinstatement out there. So if you want to reinstate your layer, it becomes almost cost prohibitive to do it using an ILS contract. So anyways, let's go to traditional reinsurance. So what is a traditional reinsurer? So just as a primary insurance companies, you know, your State Farms, your Allstates, your UTSAs, and all the other ones out there, they're writing automobile homeowners products, and they're taking a risk from, you know, the East Coast, and they're taking risks from Texas, and they're taking risks from the West Coast, and they're taking risks from, you know, central United States. And then if you get large enough, they're taking risk from South America and Europe and every place else, depending on your your insurer. And so they're taking risk from all over, right? And so they get to average out the cost from all the risks that they take in every place and figure out, you know, what their costs are. Well, a reinsurer kind of does the same thing, but they're taking the riskiest of the riskiest stuff. So some of these companies might not ever have a loss in a year. They might have, you know, a ratio of losses to premium that's very, very low in 1 year because there's just no catastrophes. Happenstance that they wrote in the area that there were no catastrophes, and that can be a very good thing. But on the other hand, they can have very, very, very high loss ratios as well in the case that there's a lot of catastrophes. And so this reinsurer is taking risk. And in one case, you might be taking a seeding insurer from Texas, and that maybe a Texas Mutual or something like that. In another case, they're taking an insurer from the Northeast, mutual company or something like that. Or maybe they're taking a US wide company. And then they're also writing risk in Europe, catastrophe risk in Europe, and they're writing catastrophe risk in Japan for the earthquakes there, and New Zealand, South America, and Central America, which they don't sell a whole lot of insurance down there, but it's becoming a little bit more popular all the time. And so what they're trying to do is they're trying to come up with a basket of risk from all over the world. And the idea is that not all the catastrophes are going to happen at the same time. And so what they're going to do is try to average out all those catastrophes on a year-by-year basis and make a profit. And the profits can be extreme. If you have, say, a loss ratio of even 20 or 30% sometimes, once you include the risk loads in there, they'll more than make 5 times as much money as what the losses are potentially in a layer, simply because it's so risky, and they just have to do it if they want to write some of that coverage. And so, but anyways, the idea is that they're writing insurance from around the world, and they're charging a nice, they're making a nice profit off of this, as they should be. And but they're providing a useful item for the insurance companies, in that I don't have to hold that capital on a year-by-year basis. I can rely on this reinsurer to do that. The thing that you have to really be careful if you're a manager, is that if you're looking at this reinsurer, just be careful of the reinsurers that you're looking at, because if they're not financially sound, then it doesn't matter if the day comes and you have a catastrophe loss and they can't pay your loss. Well, guess it's just like not buying. It's worse than not buying reinsurance, right? Because you paid for it and you're getting nothing back, and you're not getting any coverage at all. So you have to be really, really careful with that. There's 2 ways that you can manage that risk. One is to use a lot of different reinsurers. And so it's not uncommon for a large insurance company to use 70, 80, even 100, reinsurers out there, at least 50. And so you have all these different reinsurers you have on your program. So if I go back to the excess of loss program, basically each one of those reinsurers is taking a little sliver, a vertical sliver of that green portion there. And so if you had, say, 50 reinsurers, there might be one that takes 20% of that layer, and there might be another one that takes 5% of the layer, and one might even take only 0.3% of the layer, and so on and so forth. But each one of those traditional reinsurers is taking a little bit of the risk out there on your program, so you don't have to be quite as careful that all the reinsurers are going to go bust at one time. The other thing you do is you look at the ratings of your insurance company, and you just make sure that that they're highly rated. Another thing that I think that one can do is you ask for their loss distributions. And so you might ask the insurance company, and a lot of them are willing to do this just to get your business. You can say, well, if some of my larger losses in the United States are this event, and this event out of the CAT models, and they'll say, you can ask them, well, what are your losses on that, and how would your financial situation look after paying that loss? And then the reinsurer can go back and say, oh, well, we pulled that, and we look like, we're looking real pretty, and so we don't have hardly any losses from something like that. And so that's the kind of reinsurer that you want in your program that can provide the coverage when you actually need it. Any questions?
Harvey, I'm shocked you're saying large insurers have 50 to 70. I didn't know there was 50 or 70 there are actually 100 reinsurers out there that.
There's probably 100. I'd say more common is probably, I'd say, in the 60 to 70 range.
Wow, that's still a lot. Okay.
Yep. But there's probably others. I know there's 100 out there, but some of them are probably wouldn't price it the way you want them to price it, so you wouldn't include them on your program, and some of them are probably not safe enough. And some of them don't have capital enough that you would really trust them. And so you do this culling thing going on.
Right.
But as soon as you see that a number of reinsurers are contracting and they're consolidating or going out of business, then there's another group of capital that comes in and says, well, we can do that. And so a bunch of new ones start up.
Was that part of your job of having reinsurers just like 2 or 3 a week coming by to visit you, or is that somebody else's job?
Well, no, we had them come by. They didn't come by very often. Some of them, you got to be careful if you're a reinsurer and you're doing business in the United States, because the United States, if you do business in the United States, and you actually put your feet on the ground, then you can get taxed under US taxation system. They didn't really want that. So very often we actually went over there. So I've made many trips, usually one trip a year on the traditional program to Bermuda, Lloyd's of London and then the surrounding insurers there. And then sometimes we've asked the continental Europe people to come over. But we went to Frankfurt and Zurich sometimes as well to visit reinsurers. And then of course, New York City is another for reinsurance. So
yeah, I'm curious if the tax law would consider a Zoom meeting by Zoom to be on U.S. soil. Can you get around it by doing it electronically, or would they still think you have feet on the ground?
we have done that in the past. I don't think that they look at that, or at least the taxing attorneys were saying that they were okay with it at the time. Now don't quote me on that. I'm not a tax attorney, so I will not opine on that one. So
Right, I have one other question because we talked in class. I'm just curious because I'm teaching stuff I didn't deal with. I gave them the term rate online. Is that a phrase y'all use a lot on the reinsurance side? Rate online?
all the time.
Okay.
All the
Can you
time.
do it real quickly, or is it too complicated?
Yeah, it's basically how much are you paying for a dollar's worth of coverage? So
Okay.
if I pay a 5% rate online, I'm paying $5 for $100 of coverage, basically.
Okay.
So it's
So it looks really low for low frequency cats, I imagine. It looks really cheap if you compared it to like auto insurance.
yeah, well, your rates of line can vary in some of your very, very top layers. I've seen rates online go as low as like 3 or 4%.
Yeah.
They can, you get to some of those lower layers and we normally, wouldn't say we necessarily on this one. My rule of thumb and this is my own personal opinion, is once you get to past like 20% or 25%, then you need to be careful on what you do.
Okay.
Insurance, it becomes too expensive to be really economical at that point in time, no matter how low you get. So, and let me explain why that might be the case. Let's say you had one reinstatement. And so if you have let's say you had something that had a 40% rate online, which in my book would be cost prohibitive. But if you had a 40% rate online, and I've actually seen coverages quoted for more than that. And so if I had a 40% rate online with a reinstatement, let's say I had one loss, okay? And let's say it was $100 million of coverage and I paid a 40% rate online. Well, I paid, $40 million for the coverage, right? But if I had a reinstatement, let's say I had a loss, it went through the whole 100 million. And now I just paid $80 million. If I don't have the second loss, I paid $80 million for $100 million.
Right.
So
Yeah,
so now how much benefit did I get? Now, if I had two full losses, man, I was be smelling like a rose, and I would just go around, being real cocky for a little while, but I know that that's not the case. So you just have to be real careful when we get up to some of those layers.
interesting. All right. Thanks. Anybody else? I always have questions. All right, we're good.
And so then this actually is my last slide here. So if you have any questions, so we can go back and answer anything that you want to, or anything else about actuarial science, if you want to. I was a pricing actuary for a while as well. Anyways, this is your insurance linked reinsurance. And so this is really a special purpose reinsurer. So this reinsurer is basically covers, not always anymore, but usually it covers one insurer. And so let's say, you know, Allstate or State Farm wanted to buy some coverage, and they said, wow, let's get the safety of an insurance leak back coverage. And so what they do is they'll go off and they'll create a reinsurer. And that reinsurer will insure only that company. Let's say it's State Farm, they'll only insure State Farm. And so what happens in the transaction? Well, there's a lot of paperwork. State Farm does not own that reinsurer, first of all. So this reinsurer will be capitalized by investors. But State Farm puts maybe enough seed capital in there, maybe as little as $5,000 or something like that, just to get the paperwork done and everything. And they could even get reimbursed once the transaction gets off the floor. So that reinsurer just insures that one insurer, State Farm in this case, and all the paperwork is completed and everything, and it takes like 4 or 5 months leading up to this. If you've already done a transaction, and probably even longer than that if you haven't done a transaction yet. And so leading up to this thing, and then day number one happens. What happens to make this reinsurer kick off? So the investors are invested, let's say it's $100 million of reinsurance. Investors from around the world are putting in their capital into this reinsurer. And so now this reinsurer has $100 million of basically money that is sitting there. And it's like they're selling bonds, and they get the proceeds from those bonds, $100 million worth, and they can invest that money. Well, they put that money into a trust account, and usually it earns like a very risk-free type rate, because it's just cash sitting into maybe a money market account or a treasury security account at the U.S. government, or maybe it holds World Bank notes or something like that, especially if you're outside the United States. There's other companies that use, and there's also European type, very risk-free type instruments as well. And so that money is placed in this virtually risk-free environment. I'm not sure how risk-free anything is these days, but anyways, that's what I'm talking about. And now they're providing, at the very same time, day number one, they're providing a reinsurance contract to a ceding insurer, which in this case is State Farm. And so, and basically that is just like any kind of reinsurance contract. Could be very similar to what you see out in the traditional market, but probably much, much more defined. So because investors are like everything pinpointed, they don't want any guessing games that when the losses actually occur. So everything is pretty defined. So you might be 5 times as long as what your traditional reinsurance is, but basically say the same thing. And so that contract is kicking off day number one. And at the same time, the insurer is paying a premium, right? So they don't get this insurance for free. And so that premium goes back to the investor as a risk premium, because that investor is taking on risk. So what is the risk to the investor? Well, if there's no CAT event that attaches that excess of loss layer, that investor basically earns a risk-free rate on their return, plus all the risk premium that the ceding insurer paid in for how many years long that contract is. And normally these contracts range from about 3 to 5 years now. So the investor could double their money over that time period that they have this contract if there are no losses to a layer. For the less risky layers, they won't. But for the more risky layers, they could. And if they get lucky, then they get all their money back, plus all this risk-free premium, interest rate plus all this risk premium that they get. What happens if there is a loss that attaches to layer? They could lose every cent that they put into it. But they, if it happens in the first year of the contract, they could lose everything less the premium that they got from the insurer that first year. If it happens the last year, they would lose everything that they put into it initially, but they get to keep all the basically the interest that they earned on those bonds over that period of time. So they could lose a lot of money out of this. So, but at the same time, why would a ceding insurer even want to do this? Well, they're not relying necessarily on that reinsurer. They have what is called a 114 trust. They have a contract basically with that trust account that will move that money if there's ever a loss directly from the trust account. It doesn't even have to even see the light of day to the reinsurer. It goes straight back to the ceding insurer. So that it's a very safe instrument for the ceding for the ceding insurer. So anyways, that's why it's so safe. They have the money actually sitting there 1-to-1 so that the ceding insurer gets back the full money on the contract.
Kirby, is 114 unique to these type of special purpose reinsurance vehicles, or is that a greater term used in a lot of other places?
You use them in traditional reinsurance as well. So normally once an event happens and the losses occur on even with a traditional reinsurer, they're usually required to put up some amount of money, or they can also have some other instruments that they can use to guarantee the money, like, you know, banking mechanisms and stuff. But they can also use a 114A trust. So let's say, you know, I have a layer of insurance, again, $100 million, and the fires happen out in California, and it blows through the layer. Now the insurer might have a contract that says you have to place that money now that we've identified the loss, even though we haven't paid the loss out yet, and they usually don't have to pay the losses until the primary insurer pays, right? So that might be a year or two down the road. But even though they'll require that reinsurer at that point in time to place some kind of collateral, and they could use a 114A trust to do that.
Well,
and it's unique, I think, to the United States. It's set in the law of the United States. So I'm not sure if you get outside into the European community, if that is a feature or not. I don't know. I don't know the answer.
Kirby, I don't know how good your memory is. This might be going back 2 decades. We might be able to Google this, but do you have any idea what event caused the first cat bond investors to lose money?
I would think, I'm pretty sure it might have been one of the bigger losses. There might have been some smaller ones, but Hurricane Katrina was one of the triggering events. I'm pretty sure that there were some companies that went through their notes on that one.
Okay. Even though Katrina was mainly flood, it still had.
Yeah, it caused a lot of damage as well. And then I'm pretty sure that there were actually losses on that one, but you're talking about any company. So that brought up quite a bit, but I'm pretty sure Katrina triggered something. And then certainly the ones when we got to, well, Katrina was one of those events that happened in that year, so that would be the same year. So
Yeah, I imagine Harvey and some of these others. You know, I don't watch the news enough to know, but it sounds like cat bonds have been oversubscribed. So even though some of them have eaten through, they're still getting investors.
They do get hit, and as soon as they get hit, guess what happens to the prices the next year after that? So that's another thing. If you're a ceding insurer and you're buying insurance, and your layer ever gets hit one year, or even if your layer doesn't get hit and everybody else's layer gets hit, even if yours doesn't, your prices are usually going to go up, because there's now a shortage of capital until that capital can go back into the market again, it takes a while for that to happen, for everybody to get, everybody, to everybody to forget. Let's put it that way. Once everybody kind of forgets about how bad it can be, then they'll get back to the market again.
Well, this might be good for the people writing the cat bond paper, but I'm curious, do you think the cat bond market's much more price sensitive than the traditional reinsurance market?
It can be, but I'll tell you what happens more often than not is that they just won't even provide the coverage. They won't,
Oh.
investors won't even be willing to even give any money at any price. And so it's just that they're so leery of everything. Now it's becoming more and more blurred all the time. And so these investors are getting very, very savvy. And so some of them are probably just every bit as good. And you don't have like a single, it's not like, you know, me sitting behind a table and figuring this stuff out. It's like you have this, you know, group of persons that are out there, just like an investor community, like Fairmont will analyze all these. They have all these cat modeling tools, just like any reinsurer does. And they're going to, you know, basically what these firms will do, they will basically collect money from individual investors and invest it for them, and then they'll be the investor for the cat bonds. So it's like,
yeah, I'm trying to find some of those people. I've been asking my traditional bond investors, you know, from the USAA team and Victory Capital. They never buy cat bonds. So I've been out there. I actually contacted a firm that has I think the first cat bond ETF, and I emailed them. I don't know if they'll get back to me. But now you got me really curious. It sounds like they're investing in some sophisticated model. That's really interesting. Well,
yeah, I mean,
Okay.
they create their own as well. They don't just stop there, and so they will make adjustments to the models. And you know, like we were talking earlier about climate change. The modeling firms are allowing you to make adjustments to their models as well. And so if you believe that climate change is going to affect one part of the curve, and maybe, you know, maybe in the southeast, and maybe not affect the curve as much in another way, you can apply factors and different formulas in their cat models, and they'll let you apply that in there so that you can adjust the models any way you want to. And these investors do a lot of that. It's a very interesting science. It's very complicated. I'd be interested to see also what AI is doing to this, because that's probably going to take it probably one leap forward again.
Do you think these investors are going to air an RMS, or they're actually hiring their own meteorologists? And
they use air RMS, and then you know, any of the new modeling firms that have come out there. Now Karen Clark has started another firm. She started AIR, but then she sold the firm, and then she went and started the Karen Clark company. And so so she's back in the modeling business, but now it's a third firm out there, and there were other ones that were getting off the ground quite rapidly. So there's a number of firms that I'm sure that they will use, but they do get expensive. So you try to pick the one that, you know, that's best for what you're doing.
yeah, but they don't have your policyholders and their addresses and I mean, they're missing some data, aren't they, or not?
They are, but more and more data is becoming available. So if you're a traditional reinsurer, usually you provide that information to the insurer, to the reinsurer. And so, or you can, another way to do it is to provide it to your broker and do it. In a cat bond transaction, normally what you do to start the transaction off is that the seeding company will provide their data to a third party. That third party could be RMS, it could be AIR, it could be Karen Clark Company, it could be Equicat, it could be any of the firms out there. And so they take that information, they keep your policyholder information proprietary, so they don't release it to anybody. They run their cat models, and then they provide their expert expertise basically to provide curves and information and even loss curves that in a computerized form that the investors can use in their book of business. So that's
Yeah,
one
so they
way- that's
can't give
one-
your actual policyholder details, but they can essentially kind of blind use the
Right.
data.
And a lot of the information is available now. At the very first, the seeding companies did not want to give some of these investors this information willy-nilly. They just give them all this information. I mean, they could go back and contact the investor, right, once they had their lat long. But they will now it's much on a somewhat a summarized. I think you will find some companies will provide it at a county level. It's fairly common that the seeding insurer will provide county level aggregated data to the investor. And then some of them have even provided zip code information, which I think is getting a little bit risky on what they do, because that information could be used against you in the future at some point in time if a competitor gets a hold of it.
Yeah. Wow, this is great. Anybody have questions? I have one last question. So Beverly,
I had a question about if you had any opinion on how the new cat bond ETF might affect insurance firms.
I don't know the cat bond ETF. It's not going to hurt anything. I'll say that. I think the more that you can get out there in front of the investors, and the more information that you can provide out there, and the easier you can make it to invest, the better it is to get capital into that market. So that's my viewpoint. I don't know the specific one that you're talking about. It was created after I left the industry, but I can't see that it would hurt a thing. And I know that they were trying to do those type of things. There was a lot of legal hurdles that they had to go through to get that off the ground, I'm sure. But I would favor it personally. That's my opinion. I think it'll help the market become more efficient, basically.
So when we were learning about cat bonds, we called its interest rate the coupon rate. But does it actually like pay coupons or not?
do you know how the cat bond works? Does it pay a coupon every 6 months like a normal corporate bond?
Normally it's quarterly, and it does. It pays. It'll pay. Normally it's calculated as a risk-free rate, but it fluctuates based on whatever the risk-free rate is. The risk premium will stay constant on all the transactions that I'm aware. The risk premium will stay constant, but the risk-free rate will fluctuate quarterly.
That's interesting.
And
Other questions?
it can change. I mean, for a while there was no risk-free rate. There was zero. You couldn't invest the money and get a thing back. And so basically the only thing that the investor was getting was the risk premium. As a matter of fact, there were some cases where they were worried because you had to set it up because there was actually a charge. There was actually a charge back because the mutual fund or whatever you use was charging expenses, and there were no, basically the interest rates were so low it didn't cover their expenses.
Yeah. Well, I had one more question, but we're essentially out of time. But if you can give a real fast final, this has been real interesting. One fast final, what do you think of actuarial science as a career? Are you glad you did it, or you think you wish you'd done something else?
I loved it myself. I thought it was great. Don't get me wrong, I didn't like studying 400 hours or 300 hours or whatever it took for a test, but for me it was 400 hours usually. But I got it, even that for me. There was a goal, even as you're taking tests, you have the goal of passing that test. You also have to keep up with your work product, as you're passing tests once you're out of college and you have a job somewhere. But you have the goal of passing that test, and, every time you do it, it's one more feather in your cap, and you usually get a raise from passing that exam, and plus the fact that you reached another goal in your life. And so it was very satisfying for me to do that. And then once I passed all the exams, you get to focus a lot more on your work and things that you do, and get to go out there and then, look at the company and see what you can do to help them. And that's I think what a good actuary does, is go out there and they have that knowledge base, and you shouldn't be really just waiting for them to ask you to do something, but you should be providing that value wherever you see that you can provide it ahead of time. And that will really get you into the exciting projects and get you to move along into your career as well.
Yeah, I think you definitely added value at USAA. It's some of my most fun projects was working at this department. Well, Kirby, boy, this has been great. Went the whole time, probably because I asked too many questions, but I'm really curious. But this has been really, really good. Appreciate your time, and class, thank you for.
All right. Well, thanks for inviting me. I enjoyed it.
All right. Thanks, Kirby. Enjoy the rest of your day and your retirement.
Okay. Y'all take care.
See you.
All right.
All right, let's start. Today I was listening to Business Breakdown, and the name of the company during the day was Goosehead Insurance. So I said, that's interesting. If you listen to it, they use some of the jargon we talk about in this class. It's not an insurance company, really, it's an agency. So what they do is they sell other people's insurance. What I thought was really interesting, Goosehead, because I didn't know it existed, was they franchise. I didn't know there was an insurance company anywhere that had franchises, but Goosehead, I mean, it sounds like a really good career for agents because their productivity is really high, but they focus on homeowners and auto, and they hit it at the real estate level or at the lending level. So they deal with realtors, mortgage lenders, and car lenders. And they, you're a realtor and you have a customer, you're trying to sell a house to them and they need homeowners insurance. You got this deal with Goosehead. It's an incredibly productive firm, but it doesn't sell insurance, it sells others. So he kept saying IA. What is IA? Well, independent agent. So essentially they're independent agents, and their advantage is that they have a database where they can look at 100 or more insurance companies very quickly and get the cheapest rate. So interesting firm, not a large firm. It's, $4 billion, but it didn't exist that long ago. So it's a new firm. How did he create this firm? It's a lot like what we've been talking about, how much that tie between real estate and homeowners. His wife was a realtor, and she found this part of the real estate transaction to be a bottleneck, a problem. And so they created this company to hit that part of the transaction. So interesting one. There's another podcast I was listening to that I was tempted to give to y'all. I'll look for it. Maybe I'll give y'all half a class, 30 minutes off to listen to it. Its focus was on directors and officers insurance. Really interesting discussion. It's one we didn't get into as much, but it was an interesting. For you actuaries, there is a tremendous podcast, but I can't remember the name of it. I'll find it and have to send it out to you. But it's a podcast focused on property casualty insurance, which seems really bizarre. But that's where I found Root. The company Root was being interviewed for theirs. And so there are some podcasts out there for actuaries. You can't tell it's an actuarial podcast by the title of it. That's why I can't remember it, because it has nothing. The title is just bizarre, but I'll find it. He hasn't done a new podcast in a while, so he may be on hiatus right now. But so Goose was up 8%. You say, wow, that's incredible. But then you look at the market, and the market was up 9.5%. Which in my other classes talking about it, I mean, what's the probability of that? 0. There is, that's a 9.5 sigma event that just doesn't happen. So pretty crazy. They don't have the futures up yet, so who knows what it's going to be tomorrow. And Europe looks down, but that's because it closed before Trump. And we're looking at my investment no, in the dashboard team, that Trump actually put out not an X, whatever his new one, Trump Cruise, whatever, that now's the time to buy. He did that a few hours before he made that announcement, which is just the strangest thing. It's almost like he's telling people, I have inside information, you buying stocks. That's just, here's where he did his tweet somewhere around down in here. So now's the time to be buying stocks. He made his announcement and the stock market went up 9%. Give me one time in history that's a president has done anything anywhere remotely like that. I mean, it's just absolute craziness. All right. On the papers, Jared, I did put you down on workers' comp, right? So is there anyone who hasn't? I think we probably got almost everybody in there. So what we're going to do is Wednesday, April 16th, we're going to do paper 2 workshop in class. So come prepared. Remember, it's not a group paper, but you can work in groups to collect. So what are we going to try to do next Wednesday? I forget what the papers do. Someone may remind me. Where's the syllabus? I don't see the syllabus. So I don't remember. No, there it is. I think we've got a few weeks. I usually have these due pretty late in the semester. Yeah, so you got 3 weeks. So you'll have 2 weeks after that, so you'll have plenty of time. So the first thing we want to do is collect articles, videos, podcasts, other resources, etc. So come in with what you collected. Don't have the team do everything. Bring in your own stuff that you researched. Some of y'all might talk in advance. I know a couple of teams have already started meeting and say, hey, we're doing the history of safety. Why don't you do some research on these 3 items and I'll do these 3 and come with articles, or you read these pages on the IAHS or something like that. Come in prepared. And then the main thing we want to do, which is going to be pretty important, is develop a high level outline or rubric on the paper. I don't think that's how you spell paper or rubric. So we can all, I can agree with you that that's what you should do. It doesn't mean every team member is going to have the same rubric. So you might decide, okay, here's our general topics 1, 2, and 3, but on 4, you're going to focus on these 2 things. You're going to focus on these 2 things. And you split up so we hit more items. It just depends on your topic. All right, that's next Wednesday. So come prepared with what you have. Be organized. If your team meets outside of class and you got a lot of this done, yeah, I might let you leave early, but I have to see this before you leave. So make sure you're going some way into it. Questions on that? Right. Okay, let's get into this crazy pricing example. Let me show you at a high level where we're going. If you can step back and look at a high level, you may not get it perfect on the exam, but you'll get 85-90% credit by doing most of it. And so let me start at the high level what we're doing. So you're going to come up with an income statement. And it's going to look like a regular income statement. You start with revenues, which is your premiums. You're going to subtract your LIE, which is your loss adjustment expenses. And then you got to subtract your underwriting expenses. And that's going to give you your underwriting gain or loss. So that's part of the purpose of this exercise, is to get you used to what a property casualty insurance company financial statement looks like. And it doesn't look like what Yahoo Finance gives you. You look at Goosehead financials. They have total revenue, total expenses, but there's a big problem. It's this interest income. Now, this is not actually an insurance company. I should probably do another company. We do Chubb. Is there more? It kind of does work for them, but for Chubb is an insurance company. Insurance companies absolutely do not include the interest income as part of the underwriting process. Remember, float is separate. Guess what word came up in the interview on Goosehead? Anybody want to guess? What F word, not a bad F word, came up? So in the interview goes, we all know about Warren Buffett and float and all of that. And all do y'all know about that, right? It's got second nature now. I don't know if you know it before this class, but anytime someone brings up insurance, they bring up Buffett and float. So that's the one thing everybody in the investment world knows. Float does not belong as part of the underwriting side. So you would not have that up there. So this is not a good financial statement. We need to separate that out. So you can get an underwriting gain or loss. Then you're going to have your investment earnings. That's going to be separate. And that's going to give you net income. Notice that I'm ignoring taxes. All right. So we don't need to do taxes. Insurance taxes are some of the most complicated taxes there are in any industry out there. I was really shocked at USA just looking at their tax return, how complicated it was, and especially for USA because they're reciprocal, it's even more complicated. So we're just going to ignore taxes. And now I'm going to make some other adjustments. I'm going to make a risk adjustment to get to a net income. And we'll talk about that. That is very unique. Just to let you know, it's something that was very unique to USA, but I want to show it to you so you're thinking about it, especially actuaries getting to an interview. It's a really good topic to bring up and discuss. How do you handle risk when you're looking at returns? And then we're going to look at capital. Remember, is net worth. And then we're going to look at return on equity. All right, so there's the process we're going to do. You have underwriting. You have the float. This is not float though, right? This is earnings on float. We always have to make that distinction. The float is what? The reserves that they have set up. It's the premiums they've collected they haven't paid out yet, but this is the earnings on the float. That gives you a net income. We're going to make one risk adjustment. We'll get net income. We're going to have capital. We're going to see if we can break out capital down. We have ROE. ROE is just going to be net income divided by capital. There's one thing I do that makes it more complicated that I've thought about getting rid of, but it's not that bad of a calculation, so we'll look at it. We're going to do the current year. We don't do prior year, we do the current year. So a bit of a challenge because they're trying to get a premium for next year. They're doing it this year. They got to use current year data, but this year is not over yet. So they have to do this year expected. So they may not know this year. And think about it with homeowners. You're doing this in June and July, and you're going into hurricane season. Who knows what your earnings going to be this year? So there's a lot of uncertainty, but you have to use current year. And what you're trying to do is get next year. And so we're given these, we're going to grow that to next year. So what are we doing in this exercise? This is we're figuring out that number right there. We're trying to figure out the premium for next year, given all those other things. So what premium do we need to charge that gives us our target return on equity? That's what we're after. That's what Kirby, I thought Kirby did a great job. I don't know if y'all were as interested as I was. Those doing the cat bonds, boy, you can tell it gets pretty complicated. But I asked them about reinstatement. Reinstatement is a complicated thing. I was really shocked when he said reinstatement also applies to cat bonds. I don't know if you want to get that into that in your paper because that's pretty complex, but reinstatement is essentially you've had a loss, but you still want to be insured. Well, to be insured, you got to pay them a premium, and that premium is based on what those losses are. Feels like you're kind of insuring yourself to some degree. I can't believe that cat bonds actually have reinstatements. He implied that it's not common, that it's kind of rare, but it is possible. To me, a cat bond, once it pays out, I mean, it's over, it's done for. But he did talk about that. Pretty complex analysis that he does. You can tell USA is really fortunate to have him because he really understood it. But yeah, it's a complex calculation. We're using reinsurance to try to bring this capital requirement down by shifting some of the risks of some of the others. Some of that's not going to be in this question. But all right. So what do I give you? I give you all of this with one exception. You got to calculate the capital, but I give you all of these numbers. But you have to calculate are these numbers right here. Got to calculate that number. Obviously, you're trying to come up with all of these numbers. LAE, loss adjustment expenses. Oh, I left one line. What line did I leave out? Oh, the most important line. Sorry. Hopefully you have space. Out of space. What line I leave out? I can say I did it intentionally to see if you're paying attention. What's the big line we left out? Why do you buy insurance? You're hoping they're going to do what? Takers. You just pay premiums so they can, insurance company can pay expenses. You don't want any money back to yourself. You don't want some claims. Completely left out claims. Can't believe I did that. That's the most important number. They were talking about that in the podcast. He said typical homeowners, it's claims is 68% of their premium. Talk about the expense, just like we did. They did not use the combined ratio idea in that podcast, mainly because this is an independent agent. It's not really an insurance company. All right, so claims. So how are we going to grow? So we have this year's claims. How are we going to grow it? Growth is going to be a function of severity and frequency growth. So we'll grow up. How does severity grow? Primarily through inflation. So severity gets higher with inflation. Car prices go up, housing prices go up. That's the severity. It's possible severity could go up because you're expecting more hurricanes in the future, or maybe speed limits have been increased. You expect higher claims in the future, but that's severity. Frequency goes up with changes in just the number of accidents that you're expecting. But we're going to be given frequency and severity growth. The exact same thing for LAE. What's happening with severity, the size of the average loss, and frequency, the number of claims. So inflation affects the severity. Your growth in your business affects frequency. Just having more customers is going to affect that. Underwriting here is really just a function of just general inflation. So you only have one growth right there. Underwriting gain is your premiums minus claims minus LAE minus expenses, underwriting expenses. So that's pretty straightforward. So you can see this is where the math gets difficult. In order to get underwriting gain or loss, we need a premium, but we're trying to figure out the premium. So that's why I said at USA, they have a formula that does all of that. What you're going to do is I'm going to give you two premiums. You're going to have to try both premiums and see which one fits, which means you have to do the math. You can do it once because if you're lucky, the first one you try works out and you don't have to do the second one. So you kind of have to guess which one it might be. But you're gonna try both premiums, and you have to figure out which one gives you the right ROE at the bottom, right? I'll show you the formula for investment earnings. This one's a little bit tougher, but I'll show it to you. It's gonna be earnings on float, and then I'm gonna do another kind of USAA thing, plus earnings on beginning capital. So I'll show you that. It's pretty straightforward. I'll show you how to calculate float. Your float is, remember, the difference between when the premiums received versus when you pay out these three items. And so I'll show you the math on that. It's very straightforward. You'll see it. Net income is just your underwriting gain or loss plus your investment earnings. That one's pretty straightforward. So this risk adjustment, how are we doing this? The risk adjustment is going to be the change in required capital. I'll show you that. That's very, very straightforward. How much capital do you need at the beginning of the year? How much at the end of the year? How much extra risk did you need? So we did this at USAA. We essentially penalized a business line if it required us to hold more capital. Very unique to USAA, but that was Bob Davis and the way he thought about it. It makes some sense to me. It's like, yeah, you made money, but you made $100 million, but now we got to hold $25 million more in net worth. So, you know, that's not free. It's kind of a free cash flow idea. And so the net income is the net income minus the risk adjustment. The capital requirement is going to be using the surplus ratio, which is premiums divided by 3. The ROE is going to be the net income. Well, I've already got that there, divided by capital. The only problem is we're going to divide by average capital. So that unfortunately gives you one extra calculation. So it is a lot of math, especially since you have 2 premiums. So again, if you're lucky and the first premium you pick works, you're in good shape. If you try both premiums and neither one of them give you the right answer, then just go with the one that's closest because you have a math error somewhere and just say, that's the best I can do. If they're both way, way off, if their target ROE is 7% and you get 82% and negative 70%, then you obviously made a big mistake somewhere, but hopefully you'll get some credit somewhere along the line. All right. So have this in mind. The reason I do complicated problems like this is I want you to have a picture of the business with a problem like this, so you can see the business, even though you may forget calculations along the line. If you do it and get used to it, you have somewhat of a sense of the business. And this really, in a nutshell, is the P&C business. So let's look at this particular problem. So their premiums, the current year, are $750. They expect to pay 500 in claims. Their LAE is 110. Underwriting expenses are 120. So you get an underwriting gain of 20. I don't actually tell you that. You can do the math yourself. You don't really necessarily need the underwriting gain. The required capital, I don't give you that, but that's pretty straightforward. It's just the premiums divided by 3. Why? Because their premium to surplus ratio is 3-to-1. So for every $1 they have in premium, or every $3 they have in premium, they need $1 in net worth in capital. All right. So the fact that they have this product is forcing them to hold more net worth, which means they need more return on that net worth. So I gave you everything in whatever that is, lavender. Their required return on capital is 9%. Their investment return is 4%. Here's the growth in claims. They expect frequency to go up 3%. That's usually related to how many customers they're selling to, how many policies they have. Severity is going up 4%. That's mainly probably inflation. It could be other things, but mainly inflation. And then on LAE, it's the same, 3% and 4%. We'll talk about this half-year convention. This is where it gets a little bit tricky. Underwriting expenses are expected to grow 4%, and it's got a half-year convention. So what does this mean? The half-year 0.75, what it means is they expect to pay their claims out over the next year and a half. You split the difference, use 0.75, you have the float. So on average, you get the premium today. You're going to pay out all the claims over the next year and a half, but on average, you'll pay out the claims over the next 0.75 years. On underwriting expenses, you get the premium today. You're expecting to spend all your expenses over the next year, but on average, you're going to spend your expenses over half a year. So that's going to become our N in our calculation, right? So we don't know the premium, but we'll stick one in there. One of the premiums that they have is $7.50. Again, oh no, that's not it. I forget what the premium was. But let's just try to say I gave you a premium of $6.50. All right. So with $6.50, how are the claims going to grow? So you're starting with $6.50. That's not going to affect these three numbers at all. All right. These three numbers have nothing to do with the premium. The underwriting gain does, but these three numbers don't. All right. So what do? We take this year's claims times 1 plus the growth in frequency times 1 plus the growth in severity. Frequency is growing 4%, 3%, severity 4%. So if you take 500 times 1 plus 0.03 times 1 plus 0.04, you get that 535.60, right? The exact same thing on loss adjustment expenses. If you take the 110 times 1 plus 0.03 times 1.04, you get the 117.83, right? And underwriting expenses, they grow 4%. So if you take the 120 times 1.04, you get the 124.80. All right. Since our premium is $6.50, our net income is going to be $6.50 minus 535.6 minus 117.83 minus 124.8. We get an underwriting loss of 128.23, which doesn't look very good. It could be right if we're making a massive amount on our investments, but we're probably not going to make enough on the investments for it to work out. All right. That's not too tricky. That's not that hard to know how to multiply those across. It's pretty straightforward. Let's do the tricky part. So let's talk about float. So $500 is this year's number spread out throughout the year. 535 is next year's number spread out through the year. But what is the present value of 535.6 at the beginning of next year when we're going to get those premiums? So look at this formula. See if you can figure out this formula. Worked pretty well that way. So we're going to take the 535 and divide it by 1 plus. All right, this is our investment rate. We expect to make 4%. That's our float. And we're going to raise it to the 0.75. That's my mid-year convention. So I can't discount it at a year and a half. We expected to pay this out over a year and a half. But if I use 1.5, that assumes I'll pay the claims out, all of them exactly in 18 months. But we're going to pay them out evenly throughout the years. So if I expect to pay them out evenly over the next 18 months, then my N, my discount is going to be 0.75 years. Any questions on that? So this is my investment rate, 0.04. And this is my N, 0.75. And that says the present value of that 535.60 in today's dollars is 520. The exact same thing for the LAE. And you'll notice They have the same growth rates. And they have the same half-year convention. So you could conceivably, the same time on the exam, you could conceivably add these two together and just use them as one thing, because you're multiplying by the same, you're dividing by the same. So we could have done this all as 610 times 1.03 times 1.04. We could have done that, and that would have given us this plus this. And then we could divide this by 1.04 raised to the 0.75. And that would give us this plus this. So oops, this plus this. So I do try to make it so that you don't have to do as many calculations out there. To make it really, really simple, which I'll probably do on your exam, is make the expenses also 0.75. That way you don't have to do these three calculations. You can add these three numbers up and then just do that calculation one, divided by 1 plus the rate to 0.75. So I'll probably do that in an exam to save you some time, so you don't have to do this over again. But that's essentially the float that you're making. You get the premium today, and you're going to pay this out over time. But the difference in those two is what you're earning on that time delay. All right, so let's look at this. This is probably the part students have the most trouble with. So how would you get the investment income? The investment income is your undiscounted values minus your discounted values. That's what this is. And you can see if these all have the same 0.75, you can add these three together and just do this calculation once. But I did it separately. It's really easy to do this in Excel, but you're not going to have Excel on the exam, so you'll have to do some calculating around. If you show all your work and only thing you miss is a math error, you don't miss, you can get 100%. If you know, as long as you show all your work. So show all your work. Math errors are really possible in something like this. As far as rounding goes, I would just stick to 2 decimal places. Don't go any further than that. You don't go crazy. So you might be off a little bit because of decimal places, but that's fine. All right. So my investment income is the sum of the undiscounted claims, LAE, underwriting expenses, minus the sum of the discounted values. That just shows me how much float I'm making on those reserves where they're sitting there. And then I'm adding at the end my required capital at the beginning of the year, and I'm earning income on that. So my beginning of year capital was my premiums were 750. I divide that by 3, 250. So I had 250 sitting there. That's net worth this product needs, which means there's assets sitting there for this product making 4%. So I'm going to give them credit for that. Again, this was a huge USAA debate. Bob Davis said, no, that product line doesn't get the investment earnings on its capital at all. I was with the actuaries arguing the other side. It was a big battle, and we lost, he won, but I'm going to put it in there. If we're setting this aside for this business, but we're earning investment income on it, they should get credit for that investment income. Okay, so if we look at this right here, it's going to be the undiscounted claims, LAE, underwriting expenses, minus the discounted claims, LAE, underwriting expenses, plus beginning, or if you want even better, current year capital times investment rate. That's probably the hardest formula in this entire thing. But this first part's the most important one. We spent so much time on that paper one on float, and that's what it is. Float is that investment income that you get because of that time delay, right? So that's why I have it in there in a formula. I can't tell from your furrowed brows if you understand it or not, because it's kind of tough the first time going through it. No questions on that? Feel kind of comfortable? Okay. Now after that, it gets pretty easy because your net income is just your underwriting gain plus your investment earnings. You just add those two numbers together. That's very, very simple. So one thing you got to do, and this, I'm always tempted to undo this one, is on this capital part. You're going to have beginning capital, ending capital, and average capital. So I would maybe sum off on the side. You might even start with that to get it out of the way. Beginning capital is the current year premium divided by 3. The ending capital is the next year premium divided by 3. And the average is the beginning capital plus ending capital divided by 2. So you'll need those numbers. So you might just somewhere set that aside, put it down so you have it. So here, our current year premiums is 750. So 750 divided by 3 is 250. Our next year premium that we're testing right now is 650. 650 divided by 3 is 216.67. And the average is 233.33. And then this change right here, change in required capital. It's just the difference between your beginning capital requirement and your ending one. Here, the capital requirement actually dropped 33. So we're actually going to be adding that back to the net income back and subtracting it. We reduced our risk. So we're going to add that back. So change in required capital. In this case, we went from 250 to 216. So it dropped 33. We're going to subtract negative 33. So we're actually going to increase our net income by that 33. And that gives you your net income after the capital charge. And you divide that by your average capital. And here you get a negative 27.23. So obviously that's not getting your target of 9%. So that's not the right premium. So what is the correct premium? I had it in there before, but I can't remember. But let me do data. What if goal seek? We're going to change this premium. Now we're going to change this ROE to equal 9% by changing our premium. Didn't quite get there, but kind of got close. Let me take that minus that, multiply it by 1,000. Let me try it again. What if goal seek? I want that equals 0 by changing my premium. And that should get me pretty close. Yeah, there's my ROE. So let's do it all again, but with 779.72. So if they charge 779.72, these numbers are exactly the same. They don't change. So that's kind of your advantage when you do this. You got two premiums, but you don't have to calculate this twice. And you don't have to calculate the present value twice. These numbers are exactly the same. I can change this premium all over the place, and these numbers don't change. All right, so that's an advantage. You cut down on that. Your underwriting gain is going to change because your premium is different. So you will have 2 underwriting gains, but you won't have the duplicates of this. So once you do this part of it, that's set. Your net income is really not going to change either. So you have a big advantage. Let's put this in your notes. What changes when you do the next premium? So the things that change when you do next premium, your underwriting gain is going to be different. And then everything below that's going to be different. But the majority of your calculations up here won't change based on the premium. So all 3 of these numbers, these discounted numbers, and the net income, net investment income is going to be exactly the same no matter what premium you have. So you have that set up. You have to recalculate the underwriting gain, recalculate the net income, recalculate the ending capital requirement, the average, and the change. So obviously everything below there is going to change. But the majority of your calculations, in fact, the ones that change are essentially the easiest calculations. It's just adding, subtracting kind of stuff. So if we do this, we get an underwriting gain of 1.49. Our investment income is the same. So our net income now is positive. We had a small underwriting gain, but a big investment gain. Our required capital changed because our premium is much larger. So in this case, our average is 254, but our required capital increased by 991. Our net income was 32, but we subtract that change in the capital. So our net income becomes 22. 22 divided by that average capital gives you exactly the 9%. I don't know how close to 9% it is. Pretty close to 9%. So the way they file it, I think Kirby talked kind of hinted at this. They don't file 779.72. What they file is we need a 3.96% increase. So they file the increase that they need with the state. Why? Because they charge 750 this year. They're expecting to charge 779.72 next year. So it gives them a premium increase of 3.96%. You don't need that on exam. What you need on exam is to show me this. It looks massive. I don't think it's as bad as it looks. I think, it's my opinion, y'all can tell me. I think the only reason students struggle with this is because they're not going to look at it again for 3 months. 3 weeks, 4 weeks. And then they think 1 hour, because I remember doing it before. So 1 hour is not enough. So if I were you, I used to do this in college. I'd work this problem once a week until exam, just so it's fresh on your mind. That way it's just a piece of cake. And I'll give you plenty of examples to practice. You do have a YouTube video on this particular problem.
Please just hear me out. No, all work management problems are the same. They take forever to learn, and I need
P&C policy. And you can see in this case, we got the prior year from.
So that looks familiar, right? The prior year, look how the problem's set up. I give you those numbers. Oh, I do give you the underwriting gains, so you don't have to do that calculation. Required premium, the frequency, severity growth, the expense growth. So that's all in a table. The claims are paid out evenly over 18 months. This parenthesis says that is N equals 0.75. So I give you that 0.75. You don't have to know to convert 18 months into 0.75. So I give you all of this data and you do the calculations I just showed you, right? Most students get at least 78% credit for just doing the basics. Some get 0 because they freak out. But don't do that. But I walk through it. I do it by hand, as it doesn't really help you to see me do this in Excel because you don't have Excel. All right, so I'll walk through the whole thing. I've had some interesting comments on people, a lot of my classes, watching my YouTube videos, like old school kind of stuff. It's like, I do it like this, not because I can't use a computer, but because that's how you're going to be doing on exams. So I want it to look the same. But anyway, some people think I'm just really old school. All right, so you get a good sense of it. That problem's not going to help you because we just did this problem. But we do have other problems. So here's one. I don't know if I want to take a picture of this. Oh, that's the problem we just did, right? Oh, is this a different problem? Wow, it's got real similar, but it is a different problem. All right, so let me, this is on, actually you have this. This is out on Canvas. So if you want to load this on Canvas, so this is exactly, well, it doesn't have the solution, but this is exactly what it looks like on the exam. I'm going to give you all of this, and then you got to do all these calculations in here. I give you the steps down here below. You don't necessarily have to go on these steps. There are some steps like the capital you can do separately, but it does go through and show you all the steps all the way down. If you try to memorize all those steps, you're probably going to have a problem. You step back and think about it as an income statement, and you're going through the process of the insurance business. Most of the steps are pretty logical what to do. All right. So this is how it's set up in the problem. You can even see here the timing, 0.5, the same. Underwriting expenses, same timing. So I'm using 0.5 on all three of them. What does that mean? Is once you get these for next year, the present value, you can do it as one calculation. You can add the three together and do one calculation if you like. You don't have to do multiple ones. All right, so let's go through it again. So the 804 is what you're trying to calculate. Let's try 850. So in this case, you got claims of 500, LAE 125, underwriting expenses of 120. We need to grow them. Huge advantage you have here is, well, they're a little bit different, but 2% and 5% on frequency and severity, 2% and 4% on LAE. So you're going to take a 500 and multiply it by 1 plus 0.04 times 1 plus 0.02. Or what were they? I've already forgot. 2 and 5. 1.02. 1.05. And that gives you forecast for claims for next year of 535. Do the same thing for LAE. 2% and 4%. So plus 125 times 1.02 times 1.04. That gives you your forecast there. And on expenses, they're expected to grow 3% plus 120 times 1.03. And given they are all 0.5, 0.5, 0.5, 0.5, and you can see that in the problem, you can calculate each one independently, or if you like, you can add them together. 535.5 plus 132.6 plus 123.6. You can add them together. And then know that your investment return is 5% and the timing is 0.5. So remember on this, you're going to take these numbers and divide it by 1 plus the investment rate. Or what did I say, 0.5? I can't remember. Raised to the 0.5. Let me look again. I can't remember something I just said 20 seconds before. Investment returns 5% and the timing's 0.5. So 5, 5, 5 everywhere. So you take those future claims, LAE, and expenses. You're going to discount them at 5% and your N is 0.5. Or you can do them individually. You take the 535 divided by 1.05 raised to the 0.5. You take the 132 divided by 1.05 raised to the 0.5. And you take the 123 divided by 1.05 divided by 0.5. And then you add those together, 522.59 plus 129.4 plus 120.62. It's going to give you the same number. There's some rounding issues, but it's the same answer. So either way is fine. To do it this way, where you add them and then do it, the n has to be the same, 0.5, 0.5, 0.5. And I'll try to remember to do that on exams that are the same, to save you an extra step. All right, so that's that first section. It's calculation heavy, but it's the same calculation over and over again. So if you got one down, you should have all three of them down. It's not like you have three radically different things to do. So that gives you an underwriting gain, which is going to be your 850 minus the 535 minus the 132 minus the 123. So you have an underwriting gain of 58.3. I bet no one remembers, but I'll ask anyway. I'll pay 10,000 if anyone can do it. Unless I change my mind later. What is the investment income without looking? It's 3 parts of the formula. Takers. You just calculated these numbers. You just calculated these numbers. What's the first part of the formula? How do you get that float? By helping us say undiscounted minus discounted, does that help any? Even if I misspelled discounted? Does it help? Which of these is undiscounted? The red or the unread? The red, which one's discounted? All right, so what's the first part of the equation? That minus that, right? Pretty straightforward. So 535.5 plus 132.6 plus 123.6 minus 522.59 minus 129.4 minus 120.62. That's the first part of the equation. Anybody remember the last part of the equation without looking? We can give them credit for what? I talked quite a bit about it. Required capital from when? Current years. And that was what? The 750 divided by 3 or 250. We're going to say, hey, we got 250 sitting there in net worth, but we also have it in assets. So we're going to give you that 250 times 5%. We're going to make that part of your investment income as well. And rounding gets me close. All right. So it's undiscounted minus the discounted plus that current year net worth times the investment return. That's your investment income. That's the hardest part of this entire equation. You just have to kind of learn that. Keep it in mind. On Monday, I'll give you the last class's exam problem. We'll work it in class, but I recommend you do it on a calculator so you get real practice. It's really easy. This is really easy in Excel, but we don't have Excel on the exam. So net income is very straightforward. Just add the two together. 58.3 plus 31.58. That's very, very straightforward. Required capital, I give you the required capital ratio, the surplus ratio 3-to-1, which means you just take the premium, divide by 3. So 850 divided by 3 gives you 283.33. So you need beginning capital. I don't give you that, but I give you the beginning premium, the premium divided by 3. The ending capital is your premium divided by 3 again. And then the average is just 250 plus 283.33 divided by 2, and that gives you the 266.7. So you'll need these 3 numbers somewhere. You can do it. You can do it right when you start, or you can wait and do it at the end. It really doesn't matter because you don't need them until the very, very end. And then you need to change the required capital. So this part I think is simple, but students just forget to do it. So you need last year or this year's capital, next year's capital, the average in those, and the difference in those. So you need 4 numbers. Current year, next year, average, and difference. You need those three things, those four things. So here's current year, next year, the average, and the change. 283.33 minus 250. We're going to take that change out of our net income. So 89.88 is our net income minus the change 33.33. That gives us a net income after our capital charge of 56.55. And then the last equation is we take that earnings at 56.56 and divide it by the average capital. It's something wrong. Did I do the average, or that should have worked? Oh, I did the current year. Use the average 66.67. And you get 21.2%. Required return is 10%. So let's say you do this first and you get 21.2. You can't say, well, the required is 10 and 21.2 is well higher than 10. So that seems like okay. Why wouldn't that be okay? Well, there's no way the state's going to approve you making a 21% return on capital. They're just not going to approve it. Also, you have competitive issues. So, I mean, if you could get away with charging that, then yeah, charge it. But the regulators won't let you and your competitors won't let you. So definitely it's the better answer if you can get away with it, but you won't be able to get away with it. And that would cause too high of a premium increase, a 13%. They're just not going to let you have that. So it's not it's not that you're trying to find the required capital or higher, required return on capital or higher. The way they follow it with the state is they want to get as close to that required return on capital as possible. They want to be competitive. So get as close to 10. So 21 is not a good answer. It's just way too high. Right? So what would be a good answer? Well, you can calculate it and just have data. What if, we'll see, I want that difference to be 0, changing my premium. So 804.03 gets you exactly that answer. And that gives you a premium increase. 7% is probably too high as well. Anything over 5, regulators, it depends on the state. If it's Wyoming, they don't care. If it's California, they'll care a lot. Anything you give them, they're not going to like. They're going to say it's too high. So it depends on the state, but you actually file that 7.2%. There might be a third. Yeah, there's a third. So you have 3 examples in here. Now, where does all this information come from? So the actuaries handle all of the claims and LAE information. The CFO area gives them the expense numbers. My responsibility was the investment side because I knew what interest rates were and that kind of thing. Some states were picky. Florida was really picky on the investment number. I hated doing Florida's because they just made us do these ridiculous calculations that were just so complicated. I don't know why they did that. Other states, it was much simpler. Most states, they just asked me for a percent. And they usually ask what we're currently making. So right now we're making 5% on our bonds. And I would just give them that. Florida says, what are you making today? And then prove to me what you think you're going to make next year. So I had to do this forecast, and I couldn't just give them a forecast. I had to actually prove to them what the forecast was going to do. So I usually use forward curves and spreads and all. I had to document everything. So they're really, really picky. Required capital comes from the CEO or whatever. Usually it's based on what credit rating you want. For USAA, it was, USA want to be highly capitalized, and that's a debate. We may talk about this when we talk about regulators. USAA might say, 3 to 1's just not good enough. We need to be 1 to 1. We want to be AAA rated. We want to be 1 to 1. We want a lot of capital, and USAA does have a lot of capital versus competitors. But then the regulator is going to say, why do you need all that capital? That's way too much. You don't need have a return on all that capital. So you get this back and forth. And the problem actuaries have is every state is different. Some states don't care. Some states are pretty proactive and say, yeah, you need that capital. Some states just all they care about is getting you the lowest premium possible. So this is something on the corporate side. And your required return on capital. I think I told you how I got that. What formula did I use to get that? Anybody remember? Get a William Sharp. CAPM, right? So I used CAPM to get that number. And I did that with all the states and was really no issue at all using CAPM because it's just highly recognized. All right, so there's a lot of insurance theory in those formulas. A couple of USAA issues in there, but I try not to make it too USAA. So you actuaries, the actuary I dealt with in building this problem, she was real upset that I was backing into this number. She said, no, just do the formula to figure this out. Y'all could probably figure out how to write the formula, put all that into it. I'm too lazy to do that. And Bill Gates makes me lazy because I can just click on goal seek and do it. But and then she showed me the formula. I said, I can't use that formula in finance majors. I could probably use it in actuarial majors, but yeah, it's just too complicated. But I got the exact same answer she got. I used goal seek and got the same answer she got. So it does work. So, all right. So on Monday, we will work the question from last class, last spring. No questions on this? Are y'all just shell shocked or you don't know what to ask? Does it feel doable? So guess what? If you don't look at this again until the exam, it's going to be like, all of this was in Greek or something. It's kind of like I've never seen that before. It's too complicated. So refresh your memory every once in a while. If retention, the biggest thing on retention is quizzing yourself and non-normal breakpoints. So you might try it in 3 days and try it in 8 days and try it and, kind of break it up and just look at it and try it. I wish I'd done that with, when I did some of the matrix algebra stuff that we did in high school. Remember, you've forgotten all that stuff. I wish I'd just taken one problem from those classes and just worked it every week since my teens, so I could remember how to do. I love geometry, but I couldn't do any of that today. I've forgotten all the proofs, but but we just forget this stuff so much. So find somebody to kind of put there so it sticks in your memory. But you do have a good YouTube that does that. Well, we will, the week before the exam, we will work some of these problems in class just to give you some refresher. And what I recommend that you do, and I did this at UT Austin, I went to all the review sessions as if it were the exam. So I studied for the review session as if it was the exam. And then I just sat there and answered all the problems, all the questions. I found that so much more valuable. If I go in without studying, then it just freaks me out, first of all. And also I'm taking notes on stuff that are already in my notes. So now I have 2 sets of notes. But if I go in already studying, if it's an exam, it gives me great confidence and I only have to take notes on the stuff that I don't have correctly written out. So I'd recommend when we get to that point, you have 2 major math problems on the final. You have this, and then you have the bootstrapping problem, which is not too difficult of a problem, probably much easier than this one. Those are the only 2 problems you have. This one is a bear because there's so many calculations, but I don't think it's as difficult as it sounds. All right, good. All right, so let's talk this issue of accident year versus fiscal year. Actuaries, this is true on the life insurance and the property and casualty side. Actuaries think about risk in the year that they wrote the policy. So if they wrote the policy in 2020, that sticks with that the whole time. They may not know how much they're actually paying in claims until 2023, 2024. And as they adjust and those reserves, remember the word Warren Buffett used, developed. As those reserves develop, those changes are going to affect each calendar year accounting statement. And we're going to see this when we look at Schedule P. It's going to affect every accounting year. So your 2020 business, you wrote it in 2020, but in 2023, you go, oh, whoops, we need to add $20 million more to our reserves. Or the accountants see that as a loss for 2020 for this year, but the actuaries don't, and that's all part of 2020. And so we'll see that when we look at Schedule P, we'll actually calculate those numbers. Actuaries are real strict. This is the policy we sold in 2020. This is the policy we sold in 2021 and 2022. When I worked with life actuaries, they knew their mortality for each year. They knew their expenses for each year. They could tell you each product, how profitable it was over the life of the policy. It was really quite amazing. And I don't mean they did this in 2024 and 2023. They were doing this in the 80s when we just got desktop computers. So they were, some of y'all studied activity-based costing probably in some of your accounting classes. Life actuaries have been doing that since the 60s and 70s. I mean, they're really far ahead. It's real precise. I was amazed at just the data they have, but they have to think this way because that's really where the risks are. If you look at the accounting, you can think you're having a great year, but you're not having a great year. You really had a great year 3 years earlier, but you just didn't know it. But you're fixing the books this year. So it ends up, making you look better or worse than you really are. If you're investing in these firms, you would actually want to make these adjustments. Did they have a great year this year, or did they really have a great year 3 years ago? And when you have Schedule P, Schedule P allows you to do that. Schedule P allows you to look and see, oh, wow, they made a big adjustment for this year, but they did it, or for 2020, but they did it in 2025. I need to adjust my 2025 earnings if I'm going to be valuing the firm for that adjustment for the prior business. All right. Let me show you the schedule. So we will get into Schedule P. We'll do this next. Let me find it. All right, so let me tonight, I'm going to quickly introduce it to you. I love Schedule P. Do you actuaries, have y'all done Schedule P yet? You know what that is? So Schedule P is wonderful. I had a consulting business that lasted like 1 year. I was just too busy. USAA let me do it. And the only client I got was a life actuary who was working for an investment firm who wanted to get property and casualty business, and they needed a stochastic model for P&C. I can't build a stochastic model, but I can build the base forecast so they could stochasticize it, if that's a word. And so I built it for them, took 1 week off of work. They paid me a lot of money for 1 week off of work. I built the model, gave it to them, and the life actuary says, okay, I can't do this. It's too hard. And they decided not to do it, but they still paid me. So I was happy. That whole thing was tied to Schedule P. And you'll see why Schedule P. So let me introduce it to you, why I find it such an exciting one. So here's Schedule P. And get it to all fit in one place. And you're going to get 2 parts of Schedule P, and you can do a lot of work with 2 parts of Schedule P. The first one is the Part 2 summary. This is the incurred. I don't know if y'all remember what the word incurred means, but incurred means how much ultimately they expect to pay out in total. The next part 3, is how much they actually have paid out. So obviously this schedule has to be greater than this schedule. They can't say we ultimately expect to pay out 7 billion, but so far we paid out 8 billion. That wouldn't make any sense. So let's see if y'all, how smart y'all are. I know you're really smart. Let's see if you're geniuses. What do you think the difference in the amount they expect to pay out in total minus how much they've already paid out? What would you call that number? You could call it float, but what else is it? Warren Buffett called it float, but what else would it be? Remember, float is how much that timing before paying out claims versus when they actually pay them out is how much they're expected to pay out. Any guesses? It's on the balance sheet. What did Warren Buffett say again?
Reserves.
Reserves, great. Done. Okay, are you an X-ray major? Oh, okay. Yeah, that would be the reserve. So if you go on the balance sheet and look at reserves, it's going to be different than what they ultimately expect to pay out minus what they value pay out, and which is one of the questions on the exam. I'll say in the year 2025 for 2002 business, what reserve would you set up for that? You would say, okay, well, they expect to pay out that much. So much so far, they paid out this much. So the reserve is going to be about $300 million. All right. You'll get these 2 tables on the exam, and we're going to do 3 or 4 calculations that I think are really, really powerful. calculations. Just before we leave, just here's the accounting years and here's the accident years. The accounting years is what they're learning over time. But you notice this is the 2002 business. When they started it out, they thought they were going to pay out 6.7 billion. But I'll give you a much more recent one. They thought they're going to pay out 6.7, but 7 years later, they now think it's 6.9 billion, which means their 2002 business net income statement was overstated by 200 million because they should have had $6.9 billion in claims, but they only took 6.7. So their net income for 2002 was 200 million. You must say 200 million, big deal with 6 billion. But if you look at their net income, that's actually a huge part of their net income. So a lot of these firms, if you take these adjustments, and how quickly did it take them to figure it out? Pretty quickly, right? By the next year, that whoops, remember Warren Buffett? You used to call it whoops, the development. So they figured out pretty quickly, wow, we did not reserve enough. We need more. Same thing seemed to happen here as well. But what happened here? 6.5, then it drops. So it can go either direction. Remember Warren Buffett kind of implied that almost all firms start off low and end up high. But if you compare these across, they're actually pretty, it kind of jumps around. Some are higher, some are lower. This one's quite a bit lower, $200 million lower. So they do tend to be a little bit offsetting over time. If you take a big year like Katrina or Harvey, those years where you have a major catastrophe late in the year, that's where you start seeing a lot of the noise. So we'll use these schedules. I love these schedules. If I were an actuary interviewing with a firm, I would get these Schedule Ps and be looking at them before the interview. Just some interesting insights that you can get from it. So anyway, we'll work on this next class. Actually, next class, we're going to work a pricing problem in class. So I'm going to bring that in. So that may take some time because it's heavy calculation. All right, I'll stop it there.